I want to thank everyone for coming here today. I'm hoping to show you some techniques and processes that will apply not just to NeoWave. If you're not a real NeoWave fan or if you don't know a lot about it, I think you'll find that these techniques can be used to improve any kind of approach. I've tried to pick out some of the innovations that I've made over the years that wouldn't be just NeoWave oriented, but they would be applicable to most kinds of analysis. Primarily, the approach that I use is evolved over the years. I now call it NeoWave theory, which is sort of a combination of the word new and waves, and NE for Neely and so forth. So that's how NeoWave came about. It's a sort of superior form of Elliott wave analysis, and I think that you'll find, or you'll see today, why that's the case and why I've discovered some of the things that I have, and also why it's been almost impossible for others to understand or to arrive at these conclusions because of the way that they plot data and organize information. You'll see some of this later on today. I think when you apply these techniques as a trader or as an analyst, you're going to find dramatic improvements in your results, especially from a reproducible standpoint. Since we don't have a lot of time today and I have a lot to say, I'm just going to go right into it. Number one, I see the primary problem with the field of Elliott wave and with technical analysis in general is that many traders in the 1980s began incorporating wave theory into their techniques. And typical to how markets behave, as you start introducing a specific popular kind of approach, too many people start following it, it's worked well for a while, and then the market starts adjusting and changing over time because of the popularity of the approach. And an approach can only become popular if there's a sort of simplicity to it that everyone can identify. So one thing you should always avoid as a trader is an approach that's too simple that anyone can reproduce or use. And if you take a more complicated approach, you're much more likely to get long-term results. But back in the late 80s, as a lot of people began incorporating Elliott wave into their approach, the markets began to adapt and evolve, and one of the primary signs of that was the crash of '87. That was sort of the defining moment between the old kind of market action that occurred during the mid to late 80s and then the new kind of behavior that started in the late 80s, early 90s. So we're going to be talking about some of those changes that have taken place and how you can adapt and evolve with them instead of being sort of stuck in a rut in time trying to apply the same concepts that unfortunately have not been working for quite some time. As a trader, if you don't adapt with the markets, you're going to have serious problems continuously extracting profits from the market. So your goal as a trader, which I see again to be a major problem with most people, is they don't want to adapt and change. They want the market to fit their style, their trading approach, and if you do that, it's destined to failure over time. The research that I've been working on has been for about 14 years now, and my primary goal, like Ron said, is trying to evolve Elliott wave into a more scientific, objective approach based on a foundation of logic instead of just observation, and especially not on historical precedent. A big problem I think most people have is when they do their analysis, they're always looking for something in the past to justify what they're doing in the present. And since markets are a constantly evolving, ever-changing phenomenon, you never really reach a period in time where you're going to see the exact same thing twice. So if you're using the past to determine your future trading and current trading, you're going to run into some problems because the market will not exactly reproduce what it did in the past. As far as the solution to this problem, I see NeoWave as a primary solution to solving some of the problems that I've mentioned. This will require of you learning at least a few additional techniques, especially if you're an Elliott wave analyst already, by adding just 5 primary additional concepts, which I'll present as some of my primary innovations to wave theory. And by adding these to your technical approach, I think you're going to see dramatic improvements in your forecasting accuracy, in your trading results, especially in your confidence. Why don't we go into the next chart here? Since I'm not going to get into a lot of detail here on Elliot Wave because probably a lot of you already have some background and already know a little bit about it. But for those who don't, I'm just going to give a brief overview, and then we're going to go on to some of the innovations that I made to the field. Back in the 1930s, R.N. Elliot had started this discovery of wave analysis, and he figured out that there was certain kinds of behavior that appeared to repeat itself on all time frames. And this creates a concept called self-similarity, which, if you're familiar with fractal geometry, it's almost as if Elliot discovered fractal geometry in a way 50 years before it became popular. And so the theory is based on the concept of self-similarity. I'm going to give you an example here on the chart. You can see here, in a general way, you see a primary 5-wave advance. This is called an impulsive pattern under wave theory, and it's a pattern that moves with the trend. Now you can see if you look in some detail within this 5-wave move, there's a third wave that also breaks down into its own 5-wave pattern. So what you have is self-similarity on all time frames. It won't always look so nice and clean as this does, but you'll have larger patterns looking like smaller patterns and vice versa. So the smaller patterns are creating the look of the final larger patterns. The decline here, this is a corrective pattern moving against the trend, and you can see how there's self-similarity on the big time frame in association to the small. You'll see a large ABC, which is a way to denote corrective action, and a smaller ABC going the same direction, the same kind of design and style as the larger pattern. So it's a very important concept. It was a revolutionary concept in the field of technical analysis, that things repeated, but not in a specific time frame, but in a specific behavioral way. And so that's what makes the wave theory sort of unique. Let's go to the next chart. This may come as a surprise to most of you, especially if you haven't read The Mastering Elliot Wave, which is a book I wrote about 6 years ago. The entire foundation of the wave theory is based on the concept of waves. But until 1989, that concept had never been explained or quantified ever. And it's sort of funny. I mean, how can you have a whole theory of technical analysis based on this concept of waves, and no one ever described it before? It was sort of a generalized concept. But in 1989, I finally decided that to get to the point where you could advance the field of wave theory, there had to be a new level of specificity regarding pattern behavior. So I decided to describe waves in a very specific way, and I gave this wave a particular name called a monowave. This is the smallest kind of price action you can see on a chart, and it doesn't matter the time frame. Whatever the chart time frame is, you're going to see movement like this when you properly construct your charts. And this means this is a monowave is the distance from one change in price direction to the next. And this may sound like a little unimportant kind of event, but I think it was that definition that sort of bridged the gap between the established plane or level of Elliott wave that was going on up until, say, 1989, and that definition sort of bridged the gap, sort of like a quantum leap in the field of technical analysis that started to allow a whole new field of discoveries and information to be made. And that's where NeoWave came from. It's sort of like how Einstein's theory allowed for whole new areas of scientific research. So this sounds minor, but it was a very important step. Let's go to the next chart. Waves are categorized several different ways, by class and by degree, and within each one there's some subdivisions. So if you're dividing the classes up, you have impulsive patterns, which I showed you earlier. These are patterns that go with the trend of one larger degree. It's always defined by the next larger degree. Corrective patterns are patterns that go against the trend of one larger degree. It's very important to realize they don't always go up. Impulsive patterns don't always go up, and corrective patterns don't always go down. This is just publicly acceptable, you might say. The degree concept is another area that's very important to the wave theory, but is very undefined. And I'm going to be talking about how to further define this later on today. A degree just is a way of denoting magnitude and position of a market's price action using wave theory. There's other ways of structuring patterns and defining them, but we're not going to go into that detail today. The concept of a monowave on this chart, remember, it's whatever you can see between one change in price direction and the next. And when you plot your charts properly, which I'll show you how to do later, this particular move here is a monowave. This is one, this is one, this is one. Every single change in direction creates a monowave pattern. Now, a monowave can be grouped together to form what I call polywaves and macrowaves and so forth, but these all have to follow very specific rules and cannot be left up to the imagination. A real downfall of the wave theory is how much flexibility there is between one person's opinion and the next. If you're applying a more rigid set of rules, which NeoWave provides, you're not going to have this flexibility, so you have a much more rigid and scientific approach. This gives you sort of a visual idea of the difference between NeoWave and Elliot wave. Sherman, can you straighten out the chart? The Elliot wave concepts you could consider sort of in this subset here, or this set, and then NeoWave concepts sort of surround Elliot wave, making it more scientific, more regimented, and none of the NeoWave rules conflict with any of Elliot's original rules. So I've sort of picked up where Elliot left off, added a lot of new dimension to the theory, and made it basically scientific. Let's stay on the previous chart, Sherman. The primary foundation of Elliot wave, if you don't know, was pattern recognition and Fibonacci numbers. NeoWave's foundation adds to that a foundation of logic, limits, very specific limits, and self-confirmation. These are some of the concepts we'll be talking about shortly. Without this kind of additional information, there's no way you'll ever get Elliot wave to be a scientific approach. And I think, if most of you have interest in that field, you probably experienced some of the problems that occur with this constant revision of wave counts and constant confusion. And every month that passes, you have to change everything you've done in the past. That all can be completely eliminated by applying a more rigid rule set. Another important thing to realize about NeoWave before we go into the actual important innovations that I made is that NeoWave is completely non-curve fitted. It's, as far as I know, the only technique that I've ever known of that has nothing to do with attempting to compare the past to predict the future. In 14 years, I've never looked back and tried to determine, well, this thing did this in such a way, and that means it's going to do this now. The whole scenario of what's going to happen in the future is totally determined by a logical process of deduction. And so it's a completely different way of thinking about market action. And you're not looking for repetition, you're looking for evolution. Okay, let's go to the next chart. These are the five primary innovations that I wanted to discuss today. There's a lot of subcategories to this, but what I call NeoWave charts, NeoWave rigidity, self-definition, limits, and self-confirmation are all the techniques we'll be talking about today in some detail. How these can be used to take Elliot wave from the nebulous, sort of difficult process to a much more useful and scientific, confident process of analysis. I'm going to discuss each one in a little detail, and then I'm going to go into some more detail later. First thing you have to do when you're attempting any kind of technical analysis, and this sort of astonishes me that most people don't talk about this, but if you don't standardize the data collection process and the plotting of that data, you're never, ever going to arrive at any kind of useful, reproducible techniques. I'll explain to you very specifically why this is the case later using a comparison between cash data and futures data. But you have to standardize your data collection process. As I mentioned earlier, NeoWave is much more rigid and Elliot wave is much more flexible. So we're going to talk about why this is the case in a short period of time. The self-definition concept, this has to do with the market defining to you instead of you deciding based on some concept or perspective that you particularly like. The market defines to you what constitutes certain degrees, certain pattern behavior, and it's all defined by the market. You're really not putting your own opinions into the situation. It's telling you little by little what to think and what to do. The idea of limits is completely missing from the orthodox Elliot wave approach. This has to do with limiting how long patterns can take in relation to one another, how much price movement can occur, how complicated they can be, how many monowaves one pattern can have in relation to the other. And we'll talk about what those limits are. And then the last area has to do with self-confirmation. This was probably the most, That's a profound innovation to the field of wave analysis. This allows you to completely remove yourself from the final decision process. The market, by applying these techniques, will tell you whether you've done your homework correctly. It becomes sort of the teacher grading your test instead of you making that final decision and then having to argue it with someone else. Okay, we're going to go into some detail about each one of these innovations. These would apply to any kind of technique, so all the ones that I mentioned today would have almost in every way some application to any technique that you use. First area has to do with market suitability. When you're working with a technique, you need to decide, what does this technique focus on? What is the primary foundation of this technique? Does it have a philosophy that markets move based on mass psychology, like the Elliot wave theory does? Is it based on astrology? Is it based on pure mathematics? Based on the type of approach you use, you need to make sure that the markets you're following are suitable for that type of approach. For example, with Elliot wave theory, it does depend on mass psychology. So obviously you can't follow a market that only has 50 or 100 people involved in the buying and selling of a product. We're talking about mass scales. Thousands or millions of people need to be involved for the net result, the Elliot wave pattern, to be visible on a chart. So you want to make sure that the technique you're using fits the market that you're following. You can't follow agricultural markets with Elliot wave because it's not based, its primary foundation is more weather-based, and that means you can't follow wave theory on those kinds of markets with any great success, at least. First thing you want when you're dealing with wave theory, you'll have to decide for other markets. I can't go into details about every single approach and which kind of strategy is best for which markets, but for wave theory and for NeoWave especially, you need to make sure that the market you're following is a non-consumable item. The reason for this is that you have to have a perpetual life to the products that you're following. If you don't have a perpetual life, it doesn't allow for a building and a growth and decay process, because wave theory depends on a growth process. If you try to follow corn has a shelf life of maybe a few months or whatever. It obviously doesn't have a perpetual life nor a lifespan of at least 10 years, so you're not going to have any great success following the corn market. Once it's grown, it's consumed, it's gone, and that's the end of it. Things like currencies, stocks, gold. Gold happens to be an indestructible element. No matter what it's done to it, it's still available and can be recaptured. So anything that's indestructible, has a long-term lifespan, that can be used for wave analysis. It also is very important that the item that you're following does not have, time does not have an effect on its value necessarily. Obviously it can fluctuate up and down, but if you're following a product that automatically decays with time, wave theory is not going to work. It has to be something that is more based on the opinions of people than on deterioration of value. Like I said earlier, it has to be affordable and readily available to thousands of people to make this phenomenon come alive. Does anybody have any questions before I continue at this point? Okay, let's go on to the next chart. This is, if nothing else that you learn today, this is probably the most important thing I can teach you. This is something most beginners don't realize, and it takes years to understand this concept. But when you're dealing with futures data, there's a clear process of decay that occurs over time. Right here in this real-time chart of the gold market, I superimposed the gold daily cash data and the futures data so that I forced the two major highs and lows in March and April to coincide with one another, so that you could clearly see over time how the futures price decayed. So let's say that you were trading this particular market. You decided to buy physical gold in mid-March. You held it for 3 months. It's worth the same amount 3 months later as when you bought it. But your futures contract, if you bought it at the same time, would be worth almost $10 less. You would have lost $10. Nothing happened to the actual price of gold on a cash basis. Now, why is this important? Not only does it tell you shouldn't hold long positions for long periods of time in the futures market, but it tells you that the process of analysis cannot be trusted when you use futures charts. So anytime that you're preparing long-term market analysis, if it's a few days, that's fine. But the more evident the decay becomes over time. So if you're trying to do any kind of long-term market analysis, you have to use cash data. That's probably the most important thing I can teach you today. If you don't use cash data, you're not going to get repetition of market behavior. You're going to get continuous distortion, unreliable information, and your whole attempt to make profitable trading a success is going to be pretty much thwarted, in my opinion, because of this decay process. Cash data also has a tremendous advantage that you don't have to worry about continuous contracts, connecting contracts, because what happens when this futures contract expires, you then have to jump to the next contract month, and all of a sudden you'll have a dramatic jump in price, which is another element of distortion that you don't want to have to deal with when you're trying to make your technical analysis approach more scientific and objective. Obviously, if you can't make an approach scientific or objective, then you're probably never going to be able to continuously trade successfully unless you're a really good emotional reader of the markets. One other element, which is something most people won't go to the trouble to do, unfortunately, because it's not readily available. It's not something that's easy. But you'll notice here how the upper chart is drawn in a continuous line fashion. This is what I call wave charts or NeoWave charts, and I'll show you how to do these later. The bottom chart is a bar chart. A bar chart creates an unrealistic representation of reality. When you have a bar chart, that bar is telling you that the high and low of that time frame occurred simultaneously. Obviously, that's not possible. So if you're going to do any long-term or any accurate analysis, it doesn't matter if it's long-term or not, you really need to divide and separate the event when the high of the day occurred first or the low of the day occurred first, and separate these in time so it creates an angle of motion, either this direction or this direction. Whichever came first, you want to make sure to plot that first. Whatever came second comes second. If you don't make this separation, then you never know exactly how that day unfolded. You don't know what information you may have missed. It can dramatically impact short-term analysis if the market's high and low occurred this way or it occurred this way. But you won't know that on a bar chart because it looks just like that. So that's another important step you need to take in further making your approach more scientific. Another serious problem that occurs from following futures charts is the complete unreliability of support or resistance. If you follow this cash data, which is the dark black line, let's say you put a support line across here and you'd purchase that physical gold. Obviously, the support line held all the way across. If you did the same thing in the futures chart, it held possibly here, but then it broke it several times thereafter. So that support that you thought was real really wasn't real. To compensate for this, the only way you could possibly compensate is to have trend lines that are drawn at a downward angle at the rate of deterioration of the value of that commodity. There's a premium that's added to futures contracts, if you don't know this, and that premium decays with time. The physical underlying gold or value is there, with the premium declining over time. So you'd have to have your trend lines all declining on a futures chart at that rate of decay. So why go to all the trouble and deal with all the hassles? The best thing to do is just start with cash data. Then when the opportunity comes about, let's say your analysis indicates something important is about to happen. When it is about to happen, then you start looking at the futures data and you start superimposing it or adjusting it to figure out where you would enter based on that cash information. Any questions about this? Okay, let's go to the next chart.
I guess that depends on what time frame you're looking at.
Yes, the shorter the time frame, the less the deterioration becomes a problem. If you're intraday trading, then that's it. There's no problem. A month or more is when the problem really starts to become evident, especially over 3 months' time. You shouldn't trust any futures data past about 1 or 2 months. Any other questions on that? Okay. This has to do with the plotting process. I mentioned earlier I would describe to you how I plot charts. When you're working with cash data preferably, you want to determine each day or each week, each month, which actually came first, either the high or the low of that particular month. And this, again, this process is done to enhance whatever techniques you currently use, not just for wave analysis. So if you determine that for this day the low came first, the high came second, you would connect those two with a straight line at an angle, and then the next day's high came first, the low came second. You connect one day's high to the next, and then down to the low, and so forth. So you create a continuous flow obviously, the wave theory is based on the concept of waves. This looks much more like waves than bar charts do. So it enhances your ability to analyze wave patterns by plotting charts in this fashion. Okay, let's suppose on this day you determine the low came first, the high came second. So you put a dot at that price, and then when the high came second, you move over in time, one half time unit, 1/2 day, whatever, 1/2 week, to the right, plot your second point, and then connect those two with a straight line. And the next day, let's say the high came first, the low came second, you then connect the previous day's high to the new first high of the next day and the secondary low of the second day, and you just continue that process. Not worrying about closes, basically. Just you're looking for extremes in price, because remember, wave theory analyzes extremes of emotion. So you're looking for extreme peaks and troughs in that emotion. And by plotting it in a wave fashion, you'll see this emotion unfold in a much more interpretable fashion. Does that answer your question? I can explain it to you after. Any other question? Yeah.
If you have a high and a low and it closes in the high,
Yeah.
if the low came after the high.
Right. If it's a really wild day, that brings into account some extra situations we'll have to explain to you after class. Okay. Remind me, and I'll go over that with you. Because of all the problems created by bar charts, futures charts, some people like to put charts across a wall and cover multiple years of time. The deterioration of data and so forth, it becomes evident why, if you use all these tools, why no one up till now has been able to, you might say, innovate the wave theory to the point that I have, because they're using data that is unreliable. It's like asking a scientist to come to conclusions, not telling him the data is inaccurate. Obviously, the conclusions he arrives at won't be worthwhile. So it's the same idea. You have to standardize everything so there's no flexibility in your foundation, and then all these other concepts start to become obvious over time. And I've built up these concepts over about 10 to 14 years. And the greatest benefit or advantage that I've discovered from this is that the reliability of patterns, the reliability of forecasts is incredibly high when you go to the trouble and extent of doing what I'm talking about. Otherwise, you're going to be constantly in this situation where you can't ever really determine what always works. So you're left with a situation where you have to deal mostly with probabilities, like 50% of this time this technique works, 70% of the time, and you really have no idea whether this absolutely has to work or not. But all NeoWave concepts are based on mostly absolute behavior, and that's a big difference from most approaches. Let's go to the next chart. This has to do with the concept of rigidity, and this is sort of a theme I've been talking about the whole time. A lot of people, let's say the orthodox Elliot wave analyst, if they were to see this particular move on a chart, immediately, no questions asked, would call this a 5-wave move. But there's a lot of logical problems with this kind of counting, this very simplistic approach to counting. And when you understand NeoWave concepts, which are rationally and logically based, you'll understand why you can't do things so simplistically. Number one, the primary problem with this count, this is supposed to be an impulsive pattern. That's a move that goes with the trend, and it's composed generally of 5 segments, or it always is. The middle section, or one of the advancing segments under NeoWave, has to always extend, which means it has to be significantly longer than the other 2 advancing patterns. Under orthodox Elliott wave, you can take that part or leave it. It's sort of up to your judgment. That's a major problem, because this is one of the most significant rules of the wave theory, is the concept of extension. The secondary, or probably the second most important concept, is the concept of alternation that occurs between 2 and 4 waves. This means you have a correction that takes 5 days, 5 points. You want to make sure, if that's wave 2, that wave 4 takes 10 days and 10 points, or behaves in a clearly different fashion than wave 2. If that isn't present, you don't have an impulsive pattern, period. Under NeoWave, at least. Under Elliott wave, you can take it or leave it again. So by allowing this flexibility, anyone who assumes that you can have an extended wave or not, or you can have alternation or not, there's no way their approach to wave analysis will ever become scientific, because those are the 2 most important concepts. If you ever break them, your count is wrong.
Is that Elliot?
No, not really. I don't know how specifically Elliot defined that, or how much he was convinced it had to be present. But I know from 14 years of doing this that you have to have alternation between waves 2 and 4, You have to have an extended wave. If you don't, something else is happening, and you have to know what that something else is. And usually, through the concepts that I describe and literature that we have, it guides you in the right direction. Any other questions? In the back?
Define the extended wave by more complex waveform or by
By price length. There's a definite difference between subdivisions, the number of mono waves in a pattern, the time it takes, and the price consumption of that move. So extension refers specifically to price consumption. Then there's other rules you have to apply for determining whether you're dealing with the same degree or not, and that has to do with the complexity and the time consumption and so forth. Any other questions before we continue? I'd like to go to the next chart and show you what would have been the appropriate count from the very start. In other words, I would have never been duped into assuming that move was a 5-wave move. I would have known from the very start, with no questions asked, that we were really dealing with what's called a complex corrective rallying. And that means when you're dealing with complex corrections, that's a situation in which the corrective patterns are all very similar. The advances are all relatively similar, not a lot of difference. Anytime you see extreme similarity in price development over time, like a majority of the advance in the stock markets, you may find this hard to believe, but from 1994's low up to most of 1995, if you channeled that out, you see it almost perfectly channeled the entire time. That's a behavior trait of corrective patterns. It's not a behavior trait of impulsive formations. So these are all traits that tell you you're dealing with corrective price action. Now, if you choose not to follow these rules, what's going to happen? You're going to constantly be revising your wave counts. You're going to constantly figure out that you're wrong. You're being entering trades that don't work out. It allows for lots of confusion. Okay, let's go to the next chart. Oh, yes.
Did you just say that this rally is a corrective wave?
The one we just looked at, yes. A complex corrective. Oh, in the S&P? I was talking about the S&P in general. Yeah, the majority of what we see in the S&P for the last 8 or 9 months is corrective price action, despite the fact.
Correcting what? Yeah.
Okay, that's. I'm glad you brought that up. Actually, I didn't think about talking about that today. The concept of corrective action and impulsive action has nothing to do with the direction that it moves, or nothing to do with what happened before or after. It's like saying, this car is a Cadillac, this is a VW. What kind of, what is it Cadillacing? It doesn't make any sense. It's a corrective pattern because of its design. It's an impulsive pattern because of its design. It has nothing. The word corrective could be, anything. It's just we're so used to the word correction meaning a reaction that it's probably a misnomer. It should be thought of in a different way, such as I can't think of a good name right now, but it's the type of behavior. It's the nature of behavior. It's not the result of the behavior. Do you understand?
Does a corrective wave always follow an impulsive wave?
Not necessarily. It depends on what the impulsive wave is finishing. You shouldn't try to force wave theory into specific grand themes. A lot of people seem to think that you have 5-wave patterns up over whatever period of time and 3-wave patterns down, and that's sort of like the cycle, I think a lot of people call it. You shouldn't think in terms of that because that cycle does not finish anything. If you have 5 waves up and 3 waves down, what have you finished? Nothing. Under wave theory, at least, you finish nothing. The only thing you should be concerned with is each individualized formation. So you should look for the impulsive pattern and its character traits, the corrective pattern and its character traits, and then you have to learn to connect them in a logical way so that they explain what's going to happen next. It has nothing to do with the direction they move or what name you give them. Does that make sense? Yes?
The fact that this is a corrective pattern means it's sort of somehow inherently weaker or will resolve
No.
in favor of you, doesn't it?
No, not really. Has nothing to do with it.
What does it imply?
Corrective action is action in which the public is not involved in the trend on a grand scale. In other words, if you have 100 people involved in a stock market, and that's the maximum that is allowed, you're in an uptrend. If only 20 of those people are involved in that uptrend, you're going to have corrective market action. You need to have the majority of people involved in a price move for it to produce impulsive action, because the majority have to be duped into doing the wrong thing at the wrong time so that the few can make a lot of money off of the many. And unless you have that kind of action, you pretty much have an environment where professionals are trading against professionals. Does that make sense? Possibly. But volume is a relative concept, so you have to be really careful about using anything that's relatively based without any way to structure it. That's a very complicated topic. I don't want to go into that right now. We can talk about that later. Anybody have anything else? Okay. This is another important concept that you should adopt, I think, no matter what kind of technique that you use. When you're looking at charts, and let's say you've decided to make wave charts a regular part of your analytical process. If you're looking at a chart that looks like this and has hundreds possibly of monowaves on it, that's way too much subdivision to arrive at a reliable conclusion. Wave theory depends on limits imposed on everything, so that you want to have limits on how much information you analyze at any one time, along with lots of other things. But the ideal time frame, if you can just visually get used to this, and maybe you can refer to it over time, the ideal time frame is indicated by diagram A and diagram E. Those are pretty much the range of complexity that you should see on a chart. If it's anything like this or like this, that's presenting you with too much information. It makes it very difficult to come to accurate conclusions. And this small amount of information, and this especially, is not enough to arrive at any kind of conclusion. So your complexity of your chart has to fall into a particular range to arrive at accurate conclusions. So what does this mean? Let's say that you're following a chart on a daily basis. It starts looking like this. Well, what you want to do is create a weekly chart of the same time frame so it starts to look like that. And you pay less attention to this daily chart and more attention to the weekly regarding that time frame. And when you're studying the daily, you should start to focus in on a much shorter time frame that you can once again analyze. Does that make sense? Okay, let's go to the next chart. Innovation number 3 is what I call self-definition. This is the market defining where you start and stop your patterns, the market defining what constitutes a degree. Most people, if they were to look at this chart, would immediately probably start doing the analysis from this lowest point here. Maybe from the beginning if they're doing just pure mathematical analysis, but if they're doing any kind of overbought, oversold, trend following techniques or whatever, they most likely would start from the lowest low. The problem with that is if you always assume that patterns and trends start from the highest high or the lowest low, you're never going to get the coherent behavior that you need to accurately predict market action. Unfortunately for most of us, I guess as analysts and traders, the markets don't conveniently always terminate patterns right at the top or bottom. The trend, visually speaking, yes, may terminate at that point. But from an analytical standpoint, no matter what kind of technique you use, you need to realize there's certain kinds of behavior that have to happen near a top or a bottom to tell you whether that highest high or some later lower high or some higher low after the low is actually the beginning of the new trend. So let's say you're using an overbought, oversold indicator of some sort. This is the bottom you're using the analysis on. Maybe it indicates it's very oversold. But the trend of the market, a real powerful move, doesn't start until the next higher low. And that's an indication that you're starting your analysis from an improper point. Let's go to the next chart and I'll show you how this is actually determined. When you're attempting to start an analysis process, or it's an ongoing process, you first would find the highest high or lowest low, figure out which direction you're trying to predict. If the market's generally going up, then let's start off the bottom, which in this case it's doing. So first thing you want to do is mentally or actually draw a vertical line right through the bottom of that lowest point. Then you'll want to go backwards to some previous important point. It doesn't matter because everything's relative under the wave theory. So the further back you go, the bigger the degree you're analyzing. So we're just going to go back a short period of time to an important, relatively important high here, market. We're going to call it point A. The distance between the starting line and point A will be called segment A for this purpose. The distance from point A horizontally until it hits the next piece of price action will be called point B. And if you measure the distance between point B and start time, you get segment B. Now what you want to do is you want to compare the time between segment A and segment B. And when you're doing wave analysis or any other kind of analysis, you want to make sure that segment B is always smaller than segment A. If it's not, you're starting your analysis from the wrong place. Okay? Segment B always needs to be smaller or the same size as segment A. It should never be larger. If it's larger, you're starting your analysis from the wrong point, or the market hasn't started a new powerful trend that will create a complete reversal of the previous trend. It may just go sideways or something, but it's not going to do what this did here. So if you can't achieve that kind of a result, you have to keep moving your start timeline, mentally or actually, further and further to the right of the chart until you get to some low where segment B is smaller than segment A. That's where you start your analysis.
This qualifies as a starting point?
Yes, this you can see between here and here, segment A is too small in relation to B, so B is too big. You move it to the next higher low, segment B is now smaller and segment A is larger. So now you can start your analysis from this point. Now, this has a very serious application for NeoWave and Elliot wave. Yes?
Does that mean for a long consolidation, you'll take the start of the breakout where it jumped out of the box and came back to the top? And then took off?
It would just whatever it takes to apply this process. There's no specific rules there. If this process shows that segment B is smaller than segment A, then you're safe to assume you can start at that point, whatever that point happens to be. So this is the market telling you what to do instead of you putting in your own opinion. So obviously it regiments the approach a great deal and avoids a lot of subjectivity. So every one of the NeoWave techniques that I'll talk about today is a step further away from subjectivity and closer to complete technical science. Any other questions about this approach? Yeah, you could have gone to this point here and then drawn it across to whatever point touches horizontally. You want to make sure your line is perfectly horizontal to the next touch point. And like I said earlier, the further back you go, the bigger degree you're analyzing. Any other questions? You have some?
Yesterday, I listened to another Elliot wave, and supposedly it started when it dropped out of bed.
What started?
The wave started at the bottom.
Here?
Yeah, because that looks like it just went straight down. Dropping out of bed.
From here?
Right.
Okay.
But that is not the start.
Well, as far as the uptrend is concerned, no. It may be the conclusion of the downtrend, but I know from experience, if you want to reach high reliability in your pattern development and your forecasting accuracy and trading accuracy, you have to adopt these approaches. Otherwise, there's going to be a lot of flexibility, and it's going to be up to your opinion and experience, which is something I think you want to, at least I want to avoid, because I don't want to be putting my own emotions into the situation. I want the market to tell me what's the proper thing to do.
Where does NeoWave start of the bull market?
I'm going to be, at the very end, I'm going to be talking about the long-term picture of the U.S. stock market. Anything else before we go on?
I hope you come back because I just want to see your definition, your start date, your definition.
Oh, okay. Okay, let's go to page 16. That has to do with what I call NeoWave limits. You have to have, for all patterns, impulsive, corrective, you have to have specific limits on all the aspects of behavior from a time perspective, a price perspective, and complexity perspective. Let's go on to page 17. This will show you what those limits are. Now, we don't have to go into a lot of detail on this today, but you might want to spend some time studying this and maybe applying it to your wave analysis. This helps to define what qualifies as impulsive action, corrective action. If you're looking at a chart, and you see an advance or a decline, I have all the patterns here going up, but if you see an advance that's of a particular length and you think you're in a new trend, it's mandatory that the next advance is at least 38% of that initial uptrend. If it's not, then all of this action is part of the correction of the advance and you're still going to get a bigger move later on. So from a purely technical standpoint, even if you don't apply wave theory, if you see a big advance on a bar chart and you see a reaction, and then the next rally is less than 38% of the first rally, then you're definitely dealing with a situation that this doesn't relate to this. They're not part of the same event. So eventually the market will go higher after some more corrective action. So it's a very handy tool to know when you should get in, when you should get out, or when you should raise your stops and so forth. Like, for example, let's suppose this advance started, it exceeded the 38% amount, then you know you can safely raise your stop to here. If it doesn't, then you can't. You have to keep it much lower to avoid getting stopped out prematurely before the next advance gets underway. On a more common basis, this is the kind of relationship you might see between advances in a market that are part of a real trend. Remember, impulsion deal with real trends. So if you're in a real trend, no matter if you're following wave theory or not, you have a big move up, some sideways action. The next move up, if you're in a real trend, you can expect to be at least 61% and as much as 200% of that initial move up. So it gives you some parameters to work with and help to determine where you might get in, where you might get out. The maximum allowed is around 275%. This is just above a Fibonacci relationship of 261%. So, this is allowing a little bit of leeway. But if you see a move larger than this in relation to some rally off of a low, then this goes back to what we talked about earlier. What this means is this move is of a different degree. It's of a different behavior. So your real trend starts here. It didn't start at the lowest low. So if you see a move of spectacular proportions, higher, starting from a higher low that's way out of proportion to anything in the surrounding area, you know the real trend started from that higher point, not from the lowest low. Yes?
Are we talking here about typically wave 3?
No, it really makes no difference which wave it is, fifth waves, first waves. It's just the powerful or extended move of a pattern. Yes?
How do you come up with why these particular definitions?
This has just been, if you imagine that a foundation of or philosophy of anything is based on inaccurate information, you can never arrive at accurate conclusions. But when you start defining your foundation so much that there's no flexibility, certain rules of behavior start to become obvious and evident that you couldn't see before because you were using inaccurate information, improper techniques. These concepts are only derivable by using cache data, by plotting your charts properly, by starting your counts from the proper point. And if you do all these things, then these behavior traits become obvious. Otherwise, they won't be obvious.
These are your discoveries.
Yes, over the last 14 years. Yes.
So are you saying that these the numbers that you've got there are identifying a second rally based on how much the size of the first rally?
Yeah, it doesn't matter if this is the first move off of a low, a second or third or whatever. Just you have a move up, preferably one that you think is the start of a new trend. And if the next move relates to it in this way or one of these three ways, you can consider that this is all part of a real new uptrend. I'll show you what doesn't qualify as a real new uptrend in a minute. But this would qualify as real continuations of an uptrend. Okay, let's go to the next chart. This had to deal with price limits. Now we're going to talk about time limits. This is extremely handy for anyone real-time trading. Let's say that you just had a large advance in a market, and now you really don't know what you should do. Should you stay in? How long should you stay in? Should you wait through the correction that you're expecting to take place, or should you get out? Well, with NeoWave theory, and again, plotting charts properly and all the other things I mentioned, you're going to know that when you have a new advance getting underway, the time spent correcting that advance will always be, no exceptions, 100% of the time or more of the initial kickoff of that trend. Now, the confusion starts because most people don't understand that corrections don't always correct a trend. Sometimes they drift upward. Sometimes, obviously, they go sideways a lot, but sometimes they drift upward with the trend. Depending on how powerful the future trend is, it can actually drag up the corrective period. So it may appear to a lot of people as if the correction takes less time than the trending part of the pattern, but when you understand that these time elements have to be present, what you'll experience, let's say that you have this big advance, the market goes through reaction of 50% or something like that, then it rallies to a slight new high, then it reacts again. That slight new high won't be part of the new trend unless the time spent correcting has already exceeded at least 100%. If you make any new high before that 100% time element has been satisfied, that's going to all be part of a corrective pattern. Okay, and here's the other limits acceptable and so forth. The more time you go sideways, the more and more unlikely it is that the sideways period and the advance have anything to do with each other. Yes?
How do you feel about the statement, power timing, that says that commonly correct waves have 5 portions to it? Do you have any feeling more?
It depends on if he's talking about 5 waves going in a particular trend or 5 waves going sideways. You can always have any number of mono waves in a pattern, but if he's talking about a correction having an impulsive structure to it, that would be impossible.
No, I'm talking about the under your question rule.
Yeah?
1, 2, 3, 4. That has 5 waves by this definition. The unacceptable has more than 5.
Right.
He attaches a number for a common pattern. How do you feel about that?
How do I get these time or these...
How significant do you think the 5 ways count is in if you correct the pattern?
These aren't 5 ways in the sense that you might be thinking about impulsive and corrective action. These are just 5 mono waves. In other words, the complexity, you're counting every single mono wave of the pattern, And if it exceeds 5 monowaves or more, you're moving into an unacceptable range if the advance only has 1. So it has to do with multiplication. If you have 5 waves in the advance, you can't have more than about 5 times that many in the correction. If you exceed these numbers, you're starting to deal with patterns that are unrelated. Does that make sense? Okay, let's go to the next chart. I don't want to spend a lot of time on this because we have so many of these to go through. Complexity limits apply the same way. You don't want to have too much complexity in a correction or too much time or too much price action. The complexity limits just have to do with the number of monowaves. I think I actually answered the last question wrong because that was a time chart. This is dealing with how many ups and downs you have. The other chart was dealing more with how long you go sideways. But the same concepts apply. You have limits on how complicated one move can be in relation to another. Let's go to the next chart. Corrective patterns are the same situation. I really don't want to bore you with all the details again. Just realize if you're dealing with corrections, they're going to fall within the ranges listed here. If you get this kind of action, you're not dealing with corrective action. You're dealing with trending action. If it falls within this range, you very likely are dealing with corrective activity. You could be, you may not be. It may be impulsive. But if it's like this, you definitely know it's impulsive. If it's like this, it's possibly corrective. Okay? Why don't we just skip through, unless you have any particular questions about all these limit charts. They're all related to the same thing, but dealing either from time or price or complexity. So use these in your trading or your analysis to determine what is too much, what's too little, to allow it to be part of a formation. Okay, let's go over some actual practice. One more, the next chart after that. This gives you some actual practice sessions. I'd like some input here, if you can, on what's wrong with this particular chart. This would be a very common assessment for most wave analysts. I mean, you have a low, the market immediately starts moving up, it goes sideways, starts up again. It's 1-2. Does anybody realize, based on all the discussions we've had today, what's wrong with this chart? Right. The time spent for wave 2, number 1, too much time. When you're dealing with corrective patterns, that's allowed. And you want to look in the charts, dealing with limits relating to corrections. You can take that much time in a correction. You can't take that much time in an impulsive pattern. Also, the number of monowaves is too great. There'd be time, complexity, price is fine. The amount of retracement of wave 1 is fine. Obviously, if this is wrong and it's more like corrective activity, what we have labeled here as wave 1 and 2 is really wave A and B. And C is not finished. Does that make sense? Okay, let's go to the next chart. What's wrong with this chart? This is another element. This would be more, well, I don't want to tell you what it is actually. What's the problem with this chart?
3 isn't high enough.
3 isn't high enough?
Well, it should be at a greater height to go further.
Well, under the wave theory, the third wave only has to be not the shortest wave. There's no specific requirement on exactly how far it has to go, as long as it's not the smallest wave of the bunch, and it's at least around 61% of wave 1. So it is possible for this to be a third wave if the count were right at all, which is not even possible. But the length of it is fine. What?
3 doesn't look impulsive, right?
Well, that's right. It definitely, but not dealing with structure, mostly dealing with limits. In other words, price, time, and complexity limits. What's wrong? Wave 2 didn't take long enough in relation to wave 1. This is a very common mistake people make. It doesn't matter if wave 2 drifts with the trend or not. You better make sure it takes longer than wave 1. If it doesn't, then your count's going to be wrong. It will just be a matter of time before you realize that was wrong. And this is the reason why so many people who do wave analysis have been wrong continuously for about 7 or 8 years on the stock market, because their rule base is very limited, it's very simplistic, and they're allowing all kinds of things to happen that are just not logically allowable. Okay, anything else wrong with this count? There's some complex... Yeah, the depth of wave 2 is really too excessive. As a general rule, in almost every situation, wave 2 should never retrace more than 61% of wave 1. This is sort of going off this topic a little bit. But you never want wave 2 to retrace more than 61% of wave 1. There's one rare exception, which has to do with major terminations. If a market's near a major pattern conclusion, then you can get a pattern called a terminal. Wave 2 can be very large. Wave 3 can be corrective in design. It's one rare exception at the end of major trends. But normally, you can't allow for this. Also, you'll notice the complexity of wave 2 is much simpler than wave 1, exactly the reverse of what should happen in an impulsive pattern. You need to make sure that wave 2 is more complicated or as complicated as wave 1.
Well, I thought your book said wave 2 could correct 90-some-odd% of wave.
That's relating to terminal patterns. That's the one exception. So I have to, in the book I had to take into account all situations, but for normal application, for people who are less experienced maybe with all the subtleties, you should stick to the idea that it can't retrace more than 61%, and it'll keep you safe most of the time. Okay? Let's go to the next chart. Okay, what's the problem with this count? This has to do with a different aspect of limits. What you can and what you cannot allow. Any idea? Okay, it has to do with the price consumption. We've talked about pretty much everything else except for price consumption here. Notice how tiny wave A and wave B are in relation to wave C. You want to always maintain, based on what I call the rule of similarity and balance, you always want to try to maintain a relationship between waves of the same degree in one of two extremes. You don't want the wave after some wave to be more than 300% of the price, time, or complexity of the wave right before it, and no less than 1/3 of the price, time, and complexity. Obviously, you can see how wave B and wave C and wave A and wave C are different by a magnitude of 500 or 600%. They can't be considered the same degree. They can't be part of the same pattern. And most likely, what I explained to you before regarding determining the termination of a move, this is where the trend upward finished at this lower high. This is where the new downtrend started.
What were those parameters you just mentioned?
Earlier, starting, validating your start time or your start point.
300% was a high.
Oh, yeah. When you're relating patterns that are supposed to be of the same degree, you don't want two related patterns to be different more than 300% or 1/3 in either direction, price, time, or complexity. Okay, let's go to one more. I think we have one more practice session here. And realize these are common mistakes that most people make, and that's why their counts turn out to be wrong. They have to constantly revise them. They are never quite sure about what they're doing. They never have any solidification of their counts. I'll be showing you a count at the end of the session. This is the count I've had for almost 10 straight years on the U.S. stock market. It's never been changed one time. That kind of solidification and confidence in structure is only possible when you follow the rules that I'm talking about. If you have all kinds of flexibility, you'll never achieve that kind of certainty. Okay, in this pattern, the problem is complexity. Here's a degree, wave A, a certain degree, similar to this degree and this degree. These are smaller patterns of a lower degree. You notice how complicated wave A, it takes up 3 waves. Wave B is a tiny little simple monowave, and so is wave C. You don't want to have that kind of extreme difference between one pattern and the next. Not normally, at least. And especially the more complicated this gets, the worse it gets. But not just from a complexity standpoint, from a time standpoint. Notice how long wave A took in relation to wave B. There's no relation at all. It's too extreme. The differences are too extreme. So this count obviously is wrong, and like I said before, the real trend would have started here with the initial down move. And all this would be part of the correction of that down move. Now what can we determine from this down move? It took a long time to correct, right? We have a lot of complexity after the initial violent decline. That means that this decline you can determine very soon, way before the trend's over, this is a corrective decline. How do I know? Because this is taking too much time. It can't be part of a real powerful trend. So I know the very next down move we get is going to be the end of that trend. It's not going to continue on and on and on. Does that make sense to everyone? Okay, let's go to the final innovation. This has to do with NeoWave confirmation, self-confirmation. This is where the market determines whether you've done your homework correctly. You don't have to ask anybody. It's not up for debate. It has nothing to do with opinion. You can arrive at these conclusions very objectively, and it's sort of like grading your paper. Whenever you finish an impulsive formation, upon the conclusion of the fifth wave, whether it's going down or up, it doesn't make any difference, there's 2 stages of confirmation that are required to guarantee that that analysis is correct. Stage 1 is when the market breaks the trend line drawn across waves 2 and waves 4, or wave 2 and 4. What needs to happen, it needs to break that trend line and touch it or break it in less time than the fifth wave took to form totally. So the fifth wave took 5 days. You need to get down to that 2-4 trend line in less than 5 days. If it takes more time, your count's wrong. Our wave 5 is not finished. Okay, there's no debate about that. This is an absolute, guaranteed, 100% workable. I've never seen an exception to this in 14 years. Any questions about this? Second stage of confirmation has to do with when the fifth wave of a pattern is completely retraced. This is the clincher, you might say, to your wave analysis process. If you get this second stage, the probabilities of accuracy approach 95 to 100%. At stage 1, it's more in the 70-75% range. There's still some things that might happen which would alter the accuracy of the situation. Once you get both stages of confirmation, you can rely almost 100% on that analysis. You can lock in this structure as a 5-wave move, never to be changed again, and then go on with the next part of your analysis. Question?
I thought you said that it was having stage 1 confirmation. Is that 100% of the time?
No, that this has to happen. The indication that that is an actual, absolute, completed 5-wave move is about 70-75%. When it breaks this level, then it's basically 100, as close as you can get to 100%. So in other words, these events have to happen. If you don't get stage 1, your count's definitely wrong.
If you get stage 1 and you don't get stage 2.
Then it's still in the 75% range, and you have to consider other possibilities to be safe, but you don't know for sure. The only stage 2 gives you that absolute confidence.
The time requirement when stage 2 has
Yes, same as stage 1. You have to reach the beginning of the trend in less time than the fifth wave took to form itself. There's another parameter here that I didn't mention. It also has to do it in less complexity. So if wave 5 took 5 clear subdivisions, you have to get to the beginning of wave 5 in less than 5 monowaves. So if you have 5 monowaves within wave 5, the reaction to start the new trend has to be 5 or less, preferably 3 or less. So these things, I guarantee you, always work. And I think some people in here have taken my class before, I assume. Has anybody taken my personal training class over the telephone? Oh, I guess not. They're quite frequently amazed that you can explain price action to such an incredible degree of specificity. You know, talking about exactly how far a market needs to go, how long it needs to take to get there, how complicated it's going to be going from point A to point B, and it just doesn't seem logically possible to most people. But when you go to all the trouble to do the things that I'm talking about, it does become possible. Yes?
How does NeoWave address the rigid rule that the bottom of wave 4 never exceeds top wave 4?
Oh, that's an absolute rule. That's an Elliot wave rule that occurs before NeoWave. That definitely. Nothing about the old orthodox approach have I changed. So all the standard rules are still there. I've just added on top of that to make it more scientific. Any questions? Okay, same concept applies to corrective patterns, but frequently, because of the way corrective patterns move, the trend line and complete retracement are at the same point. So you sometimes will achieve stage 1 and stage 2 simultaneously during flat corrections or sideways market periods. Not all the time, but sometimes. If it's not, if the trend line is not horizontal and you don't achieve that confirmation at the exact same point, then the same rules that applied here apply here. You still have to get to the trend line in less time than the last wave took to form. It has to be less complicated, and it has to reach both the trend line and the complete retracement within that time frame. Okay? Okay, let's show some examples of this on the next chart, page 28. If you were looking at this chart, which a lot of people might come up with this analysis, I'm not sure, probably more people would put wave 2 here than over here, but if you had wave 1 here, the problem is that the reaction after wave 1 is over is too tiny and the recovery is too severe to indicate that your trend really terminated with the first high. So an event like this, if this really is wave 1, you'd have to move the termination of wave 1 to the right. You never want to have, I didn't mention this earlier, but you never want to have the initial reaction off of a higher low retraced more than 61% if you're going to consider it the start of a new trend. So this extreme recovery after the initial drop indicates that this has to be the start of the new trend, the high to the right, not the highest point, because the reaction after the initial break is too severe. That means the market really isn't trending yet. It's still working on finalizing the uptrend before the new downtrend starts. And notice by taking this approach, your trends always start with a nice, quick kickoff, which allows you to begin solidifying specific kinds of behavior that always occur from the very beginning of a trend. And if you don't do this, like I said earlier, you may have action off of a higher low that sometimes produces this action, sometimes it doesn't, and the behavior just isn't reliable if you don't determine exactly where the new trend started. Yes?
What about, in opposition to that, you often get a situation where if you look at one there and the next high up goes higher, but in oscillators you get divergence. That's often a good signal for a high looking at oscillators,
Mm-hmm.
and yet it would certainly go on more than that 61%.
All I can say about oscillators in general is that you need to realize that most technical approaches that are relatively simple mathematical approaches identify market behavior. They're not really identifying overbought, oversold, support and resistance. They're identifying a certain type of behavior. And that behavior falls into the two classes of Elliot wave or NeoWave, impulsive patterns and corrective patterns. So what frequently happens is that when you have a powerful move up, the market reacts, you get another move up that's much slower, and it's part of a correction. It'll indicate that the market momentum is slowing down, you're reaching a top. It may be a top for a long time, it may be a top for a short time, and you may get a little reaction and start another huge trend. It's hard to say, but what it's identifying is corrective action, and it can be very deceptive if you don't know whether that corrective action is concluding a trend or is part of a drifting upward pattern that is eventually going to be followed by a much more powerful advance. Does that make sense to you?
Makes sense. Because I was referring just over one, just that little blip up there.
Uh-huh.
Did I understand you say that that little blip up after one, that can't go beyond 61%?
Right. The first reaction, and then the question is that the market broke down from the high and then it retraced more than 61%. That event tells you that the real downtrend hasn't started yet. The market's recovering too much of a decline to say we've started a real new trend. So if you don't define what constitutes a trend, then you're not going to be able to use all these techniques that we talked about and really regiment your approach to a point where everything constantly is behaving the same way. Most people are always used to having to make exceptions all the time to behavior. I don't have to do that with this approach because it forces everything into specific kinds of behavior based on using the right kind of data and all the things I've mentioned. Okay, the other problem here, if you notice the end of wave B, the market broke down again, retraced too much before it really started trending. And if you were to draw any trend lines, you can see that this low here did not break any previous trend lines. So there was no confirmation of the conclusion, which means wave B should be moved over to this point. That's where the trend actually started. And the retracement is close to 61. I don't know exactly. What?
C started no more till the second.
Yeah, C would start here along with the conclusion of wave B, not at the higher point. Okay? This is a big problem for most people because almost everyone wants to terminate patterns right at the top, right at the bottom. If you do that, your analysis will just never be consistently accurate under wave theory. If this, wait, say that again? This here? This is fine. Yeah, the reaction is violent, it's fine. There's no problem with wave A. You notice how it quickly moved up, didn't retrace too much, and continued. Because the initial reaction is retraced more than 61%, indicating you hadn't started a new trend. And because if you drew a trend line across these lows, which is an important way to determine conclusion of patterns, you have the decline here, and the market retraced more than 61% of the initial drop. Okay?
So does that mean that you should expect the market to still go higher after C?
Oh, absolutely. Yeah. The minute C is finished, first of all, when you have a B wave or a pattern that makes new highs during a correction, that's a sign of strength. We haven't gone into force in the application of what you might call NeoWave force. We won't go into that today, but force is an indication based on market the market's trend and how powerful it's going to be. You're going to recognize this in the way the market behaves. So based on the B wave making new highs here, that's telling you in the future the market's going to have a very powerful uptrend. That's an indication of future force, and that's why the correction is drifting upward. But a lot of people would determine maybe this is the third wave or the C wave of an ABC or something like that, because they're not carefully analyzing the structure and they're not allowing enough time for the corrections to take place and so forth. So just as a general rule, remember when you make new highs during corrective action, the correction's not over, but you've made a new high during its formation. That's a sign of future market strength. Okay. I'm going to skip this last pattern because what I'd like to do is now make the transition. We only have a short period of time now. Make the transition into what I consider to be a very important application of all these things that we've talked about. Yeah, that's fine. That's fine. Taking all the concepts we've discussed today, plus additional ones, into account, I'm going to present to you at the very end what I consider to be the correct wave structure for the U.S. stock market. This has importance because, I assume most of us live in the United States, and this has to do with the U.S. economy and what's going to happen and so forth. This is the standard, popular, orthodox Elliott wave count that's been, I'd say most Elliott wave analysts believe this to be true. If this count were correct, it would indicate that we're obviously toward the end of a major, huge, long-term growth phase in the U.S. economy, at least as far as the stock market is concerned, that eventually we're going to have to go through a big reaction. And if you're familiar with some of the other tenets of the wave theory, we'd have to break down into the fourth wave range or lower to start to get into the correction of this entire 5-wave move. But if you remember some of the NeoWave concepts, some of the other things that would need to happen is we'd have to break this 2-4 trend line in less time than wave 5 took to form, which would mean we'd have to drop, maybe in less than 50 or 40 years, back down to about 500 on the Dow Jones. I want to make it very clear, I do not believe this is going to happen. This is what this count implies. I think it's not even, this count is not even remotely possible, but we'll go into why in a minute. But this is, just wanted you to recognize that this is the standard count. Let's go to the next chart. The reason this count is not possible just from one piece of evidence, if you think about impulsive activity, you normally think of the middle part of the pattern maybe being the longest or the most exciting or the most dramatic, most powerful. If you look at this advance over the last 200 years, the absolute deadest period of the entire 200-year market advance happens right in the dead center of wave 3, typically thought of as the most powerful, most trendy, most exciting phase of an advance. All you see here is one quick move into this corrective mess and one quick move out going into 29. The rest of it's just a bunch of corrective activity. Because of this, it makes it impossible for this count to be correct. Because if this is corrective action in the dead center of a third wave and there's only 2 primary advances and the whole rally looks like a correction, this count can't possibly be right. The implications of this observation are so profound that the last time I mentioned this, Sherman, were you at that meeting in 1988? He's the only one who can vouch for me probably on this. At that meeting, I indicated, this was 6 months maybe, 8 months after the crash of 1987. I indicated that the crash low of 1987 would never be broken for 200 years. People thought I was out of my mind. They practically laughed out loud when I said that, because this is, at a time when the consensus was so bearish on the stock market, everyone knew we were going into depression. The implications of the count that I'm going to present to you and what I talked about at that particular meeting were that the stock market was going to be progressing and advancing for the next 70 years, going into about the year 2065. Because of the fact that this is or has to be considered a corrective pattern unless the information we have is wrong. I can't give good analysis off of wrong information. But everything's worked out very nicely over the last few years, and you'll see that in a minute. But if this really is correct information, it's a corrective rally happening right in the middle of what appears to be this huge bull market in the U.S. economy. So let's go to the next chart. Yes, in the back of Cycles magazine in 1988, this is the one that created all the controversy. I didn't know what I was talking about. Everybody thought I was crazy, couldn't do Elliott wave analysis. And all those, of course, turned out to be wrong. And the only analysis that actually has been correct continuously for the last 8 years is the analysis presented in the back of that article in Cycles magazine. This is what I proposed in the article, that we were going through what I call, and what I'm not sure if I don't think Elliot talked about this, but this has to do with complex corrective activity that is stretching upward with the trend. In other words, instead of the market being able to go perfectly sideways or down, the future force or power of the market is so great that the correction is stretched upward. And that's why this looks like a corrective pattern, because what it relates to is a corrective rally within a very complex upward slanting correction that took, I think, almost 100 years. Okay, it's not correcting anything. It's corrective behavior. When it's finished, then you start impulsive behavior again. Now notice the dramatic differences in behavior that you see. This, by the way, is incorrect because this is connecting European data to U.S. data U.S. data indicates by backwardly applying rules indicates that this pattern started around here. So wave 1 is a lot longer than it appears to be in reality, or from the data that we have, because they started recording data in about 1789. So if you imagine wave 1's a lot longer, down to about here, this advance is actually shorter. This whole upward drift is concluding a huge double 3 running second wave correction in 1949, and only triangular correction at this time frame. Everyone else assumes it's something else. You'll notice the minute that it finished, the market began its largest, most powerful, most persistent advance in the history of the United States. And it's even continued with the advance here. What does that tell you? That tells you the market isn't slowing down. We're moving in to a period of increasing momentum. The market's just beginning to get underway. I know that's hard to believe.
As of today?
No, as of the last 15 years. So this starts in about 1982, and it's been going up ever since. I don't have a blow-up of this period, which shows that this period here is almost, this period here in the square is identical in design to the bigger one, and on a smaller basis, this period is also similar to this one. So we're continually stretching up more and more and more, and more complex corrective patterns getting stronger and stronger, while at the same time, most people in the U.S. are getting more and more convinced the bull market has to be coming to an end. It just can't possibly keep going on the way it's been going. Whereas this implies a complete different scenario. You can see how the thrust out of this triangle has been achieved just like it should be, and we're actually probably going to get another one of these sometime down the road. It's hard to say at this point in time when it's going to happen, but another huge advance. Eventually, on a log scale, this move has got to be bigger than this move. Now, if you do that in your mind, you'll start to realize we're talking about the Dow going up to 10, 20, 30, 40, 50,000 over 20, or actually about 60 years. This sounds outrageous to a lot of people. I've been saying it for years. The problem, when you think about it in terms of arithmetic numbers, it sounds ridiculous. But when you think of it in terms of historical logarithmic percentages, it's very plausible. The stock market from this low here up to the present has risen about 1,000,000% in about 200 years. We're talking about the market going only up about 5,000% in another 70 years. Extremely possible. Okay? Any questions about that? There's one more chart I think we have. This is the forecast that Sherman, I think, had witnessed, or at least I talked about to some degree. And this was also in the back of that Cycles article in 1988, September of 1988. This is a forecast I made within a few months of the crash of 1987. As right before and right after, and as it was happening, my expectation was that violent behavior was the beginning of a large upward rising, contracting triangle that was being stretched up with the powerful trend of the stock market on a multi-century basis. As you can see, this is what's resulted in that time frame. It's the only long-term Elliott wave count that has not been changed for 8 years, or say NeoWave count, I guess, but it has not been changed for 8 years. And I'm not completely sure yet, but I think there's a possibility that we finally finished wave 2 that started back in 1966. And that's why the recent advance is even more powerful than anything we've seen almost our whole life, at least from the Dow Jones and the S&P. So,
can you say that again? The movement of the market from 1966 to 1994 was a wave 2 corrective action?
That's what the wave structure indicates, yes. That if you go back one more page, Sherman, can you flip back one? Okay.
It's bold to say that the 80s was the corrective action.
Yeah, I know. A lot of people don't understand that because they're thinking in terms of bull markets being trendy kind of behavior. Remember, we're dealing with the nature of action. We're not dealing with which direction it goes. We're saying it's gone up, but its internal nature was of a corrective nature, and or of a nature that indicates that there wasn't enough public involvement to be the real bullish trend, the real powerful trend. This pattern here is being reproduced. If you can go back to the other chart, just look at that real quick. That's being reproduced here, but this is the tail end of it. If you remember on that, important application of all these things that we've talked about. That's fine. That's fine. Taking all the concepts we've discussed today, plus additional ones, into account, I'm going to present to you at the very end what I consider to be the correct wave structure for the U.S. stock market. This has importance because I assume most of us live in the United States, and this has to do with the U.S. economy and what's going to happen and so forth. This is the standard, popular, orthodox Elliott wave count that's been, I'd say most Elliott wave analysts believe this to be true. If this count were correct, it would indicate that we're obviously toward the end of a major, huge, long-term growth phase in the U.S. economy, at least as far as the stock market is concerned, that eventually we're going to have to go through a big reaction. And if you're familiar with some of the other tenets of the wave theory, we'd have to break down into the fourth wave range or lower to start to get into the correction of this entire 5-wave move. But if you remember some of the NeoWave concepts, some of the other things that would need to happen is we'd have to break this 2-4 trend line in less time than wave 5 took to form, which would mean we'd have to drop, maybe in less than 50 or 40 years, back down to about 500 on the Dow Jones. I want to make it very clear, I do not believe this is going to happen. This is what this count implies. I think this count is not even remotely possible, but we'll go into why in a minute. But this is, just wanted you to recognize that this is the standard count. Let's go to the next chart. The reason this count is not possible just from one piece of evidence, if you think about impulsive activity, you normally think of the middle part of the pattern maybe being the longest or the most exciting or the most dramatic, most powerful. If you look at this advance over the last 200 years, the absolute deadest period of the entire 200-year market advance happens right in the dead center of wave 3, typically thought of as the most powerful, most trendy, most exciting phase of an advance. All you see here is one quick move into this corrective mess and one quick move out going into 29. The rest of it's just a bunch of corrective activity. Because of this, it makes it impossible for this count to be correct. Because if this is corrective action in the dead center of a third wave and there's only 2 primary advances and the whole rally looks like a correction, this count can't possibly be right. The implications of this observation are so profound that the last time I mentioned this, Sherman, were you at that meeting in 1988? He's the only one who can vouch for me probably on this. At that meeting, I indicated, this is 6 months maybe, 8 months after the crash of 1987. I indicated that the crash low of 1987 would never be broken for 200 years. People thought I was out of my mind. They practically laughed out loud when I said that, because this is, at a time when the consensus was so bearish on the stock market, everyone knew we were going into depression. The implications of the count that I'm going to present to you and what I talked about at that particular meeting were that the stock market was going to be progressing and advancing for the next 70 years, going into about the year 2065. Because of the fact that this is or has to be considered a corrective pattern unless the information we have is wrong. I can't give good analysis off of wrong information. But everything's worked out very nicely over the last few years, and you'll see that in a minute. But if this really is correct information, it's a corrective rally happening right in the middle of what appears to be this huge bull market in the U.S. economy. So let's go to the next chart. Yes, in the back of Cycles magazine in 1988, this is the one that created all the controversy. I didn't know what I was talking about. Everybody thought I was crazy, couldn't do Elliott wave analysis. And all those, of course, turned out to be wrong. And the only analysis that actually has been correct continuously for the last 8 years is the analysis presented in the back of that article in Cycles magazine. This is what I proposed in the article, that we were going through what I call, and what I'm not sure if I don't think Elliot talked about this, but this has to do with complex corrective activity that is stretching upward with the trend. In other words, instead of the market being able to go perfectly sideways or down, the future force or power of the market is so great that the correction is stretched upward. Out of the chart, there's a triangle finishing the pattern. This is that triangle, but you'll notice it keeps stretching up more and more and more because we're getting closer and closer and closer to a powerful upside explosion in the U.S. stock market. And when this gets underway, it'll just be probably the biggest, fastest, largest rally in history. And this should continue for about at least 30 or 40 years. So that's where I think we are on the long-term picture. It's important to notice the signs of strength, because remember, as the market approaches the middle of an acceleration, it's going to go in a sort of a parabolic kind of advance. It gets faster and faster and faster until it hits that critical point, and you might get a huge gap opening or something. So you notice the market is moving up faster and further now than any previous. I think it's even larger than this advance if you measure it from this starting point. But eventually it should be the largest advance for the last...
You
Yes.
said when you have 2 there, it implies to me
Right. That's exactly right.
You said earlier that what has happened this year is correcting. Is it correcting?
Most of it. Most of it. From about here to here was all corrective action, because I think from here to here we're experiencing the same phenomenon again on an even tinier basis, and it's stretching up even more. This is making it extremely difficult to analyze weekly and daily price action. It was almost impossible for me for 8 straight months to figure out what was going on from 1994's low to about mid-1995. It just didn't make any sense to me. So I had to go back to really long-term charts to get away from the difficulties that I was experiencing on the daily and the weekly charts. We're pretty much we have about 3, 4, 5 minutes. Question?
I was looking at the value line index very unweighted, a little negative impact there. But what it looked like to me is if we just continue going up like we are, and sometime in 96, 97, we'll be up equivalent to the Dow somewhere between 5,000 and 6,000.
Mm-hmm.
But if we then have a bear market, just to get back to a trend line coming up from 74, it would take about a 35% decline in the market to still be in an uptrend, but above that trend line.
Mm-hmm.
Does your analysis allow for some kind of decline like that in the interim of going up?
Well, if this is correct, I still can't absolutely guarantee wave 2 is finished and that this triangle is actually correct the way it stands. It was a little strange, and so I'm not totally sure. But if we see any kind of retracement of this decline, even approaching 50%, the count's wrong. So I would say if we see, this is the S&P, 2, 3, 4, 5. If we get even down to 500 in the cash S&P, this count's wrong, and we could go through a much larger reaction where this decline in this period could be wave A, we could be in a B wave and get a C wave down before the big move. But I can still update my prior forecast, which was this was 8 years ago, that this low wouldn't be broken for 200 years. It sounded ridiculous at the time. Now it almost sounds ridiculous to think that it'll even get there again. The more profound prediction I can make now with relative degree of certainty is that we probably won't break 450 in the cash S&P for the rest of our life. That's not as certain as the first prediction, so give me a little slack if I'm wrong on that. Yes?
How does NeoWave address the size of wave 5 versus the size of wave 1 to 3? Are there any more refined rules than
Yeah, generally speaking, a lot of people may... the question was, does NeoWave address the size of wave 5 in relation to waves 1 and 3, and what are the limits imposed on that situation? That any impulsive pattern in relation to another generally shouldn't be more than 261% of any other one. So if you have a third wave and the fifth wave is the longest, it shouldn't be more than 261% of that. Generally, it would be 161 to 61, somewhere in that range. It could be as little as 38, as much as 261, but the general range is between 61 and 161 for all impulsive patterns in relation to each other. We have about 1 minute to go. Does anybody have any other?
Some time constraints on the structure that's on this, where the right-hand 1 and 2 are.
Right here? The time constraints for this pattern have already been, well, the minimum was passed a long time ago because the correction had to take longer than wave 1. I'd have to think about that for a while. That's a question I can't answer instantly. Any other questions?
What do you tell your subscribers that have happened in the next 2 or 3 months?
Well, I'm waiting right now for us to go long again. We had caught most of the recent advance over the last month or so. About 90% of it got out. We're standing aside now. I spend a lot of time on the sidelines because I don't like guessing periods that I can't predict. That's another part of the downside of NeoWave, is that because it's so rigid, a lot of times you may not know what's going on, so it keeps you out of the market during unpredictable, unsafe, more dangerous periods, and only lets you trade when things are more predictable and safe. So with a more flexible system, you trade more often and have greater risk and lose more money. Okay, we're going to probably call it quits today, I guess. But I can talk to anyone after class, after this presentation if they'd like. So I'll stick around for a while. Thank you.